Good day, everyone. I'm Rob Tetrault from robtetrault.com, head of the Tetrault Wealth Advisory Group here at Canaccord Genuity Wealth Management. And today, got a bit of a rock star in studio, our wonderful studio here in Winnipeg, Manitoba. Sunny Winnipeg, Manitoba. Sunny but freezing because it is the middle of winter. Pumped to have here with me Andrew McCreath. So he's a founder and CEO of Forge First Asset Management. Welcome.
Pleasure to be here, Rob.
It's always good when we try to get different minds to talk to you guys, our viewers, about philosophy of investing, what they do, how he manages money. You've probably seen Andrew. He's a bit of a media personality on BNN. What are you on every day?
Well, I'm actually the host of Weekly with Andrew McCreath, which is in its 8th year. And as for Morning Call, which is typically 9:14 a.m. Eastern Time before the bell, I am on when I'm in town.
Okay.
But having the pleasure of being in Winnipeg here today, of course, I'm not on Morning Call today.
Right. So quite a few appearances on BNN. Let me ask you first, how did you get started in the investment world? What kind of got you going there, and how did that story start out?
Well, my background is actually in the rock and roll business, Rob. I was in the rock and roll business for 8 to 10 years. As a disc jockey at a radio station.
Yeah, I thought you were kidding. No, this is serious.
I'm quite serious. And then I ended up getting involved in selling rock and roll bands. Instead of selling stocks, selling rock and roll bands. And I'll always remember one day dealing with a club owner who said, look, why do I want to pay that much for 2 guys? And I said, well, they're a really popular band these days, and that's what they charge. And it had me thinking, you know what? You don't buy bands by the pound. I want to go do something different. And so I went back to university. I completed a couple of degrees, an undergraduate in finance, a master's in economics, did my CFA, the Chartered Financial Analyst designation. And that was 30 years ago. I then became a sell-side analyst, in other words, writing research on industries and companies, mostly for Gordon Capital. Started by Jimmy Conacher, good old Winnipeg-born Jimmy Conacher, and then I moved over to the buy side, and I've been managing money for 25 years. The last 15 years of which has been hedge fund capital.
All right, so we'll get to hedge fund capital in a bit, but I'm curious about the BNN experience, the Business News Network. How do you like that? How did that get started? And take me through kind of what that means for you on a day-to-day basis when you're doing the show.
So I launched Forge First Asset Management 7.5 to 8 years ago. And when my partner Fatima Harani and I were putting Forge First together, I said to Fatima, I said, you know what? Why don't I get involved in television? And so I cold called the fellow that ran BNN Bloomberg, as it's now called, and one thing led to another, and I started appearing on BNN, Morning Call, and then, as I said earlier to you, Rob, Weekly with Andrew McCreath is now in its 8th year. So it was the proverbial cold call, something that you and I both know are keys to your success and my success.
Okay, so you've done the BNN, you've been managing the money for 8.5 years. So you said a hedge fund, mostly a long short or a long fund. Take me through kind of what Forge First is, what the philosophy is there, and how it started.
So when you look at the return of a security, it's typically a function of the dividend stream plus what's called the alpha and the beta. What's alpha and what's beta? Well, if the price of oil or gold goes up 5% today, it's probable that a gold stock or an oil stock will go up. That's called the beta. In other words, the movement in the price of a security that is attributable to the movement in the market or the commodity. Alpha is the movement in the price of a stock that's attributable to company-specific factors. A company changing for the better, a company changing for the worse. So the logic of a hedge fund is to go long and short companies so that you hedge out the noise, the beta, and isolate the alpha because of your stock picking ability over time. And if you're able to do it properly, then you have the potential to deliver a client a higher risk-adjusted return over time. And that's what we're trying to do with our funds, our alternative mutual funds at Forge First Asset Management. Now, our philosophy is to go long and short publicly traded companies in North America.
What Canadian, what US, what percentage roughly?
I would say on average about 30% of our exposure is in the United States, and about 70% of our exposure is in Canada.
Okay.
We do not buy private companies. We limit our small cap exposure. We're focused on free cash flow. So we buy companies like Google or Visa or CP Rail, companies that generate gobs of free cash. And we tend to short companies that need capital market access because their balance sheets are more challenged, or companies that burn cash. We don't buy privates. We always run with a diversified short book, and we also use listed index options to further hedge market risk. Okay. So it's a pretty simple, plain vanilla, long short equity strategy.
It's really interesting because the last time I was on BNN, you were on that morning and I bumped into you and they had asked me about alternatives on the show. And I had said, this was in January, and I had said, you know, I feel the market's a little frothy right now, it's a little overvalued, we're taking money off the table. And Paul Bagnall had asked me, where are you putting your capital? And I had said alternatives. I had said, we believe that there's money to be made in alternatives, taking equities off the table. And you came up to me after that and you said, Rob, you and I should definitely talk about my long short fund, because it's another form of an alternative. So here we are today as a result of that discussion. So would you consider this an alternative investment? Is that how you would consider it? Or would you consider this kind of a purely equity play with downside protection?
Well, when one mentions the term alternative investments, an investor must understand that there are numerous buckets underneath that headline, alternative investments: venture capital, private equity, private credit, long short equity. Now, I'm in the long short equity space, and thanks to a regulatory decision 18 months ago, I was able to convert my OM product, offering memorandum product that could only be sold to accredited investors, into daily liquidity, prospectus-based, medium risk-rated alternative mutual funds that anybody can buy. And so
big change in the regulatory, because back in the day you couldn't buy that.
100%. Yeah. And it's a change that is good for everybody, good for me, good for you, and good for you, the end client. And so yes, we are an alternative, but we're that type of an alternative. And for me, it's the tortoise that beats the hare. It's all about preserving capital and hopefully making a little bit of money. It's not about getting really long and betting on the market. That's not what we do. Again, we always run with a short book. We use listed put options to further hedge market risk. Our book is very liquid, our process is repeatable, and our product is scalable.
Those of you who've watched me and who've heard me or seen me on BNN you've heard some of the same buzzwords, which is kind of neat. One of the reasons I wanted Andrew on here is because we think a lot alike with respect to risk-adjusted returns. My focus has always been on risk-adjusted returns in my career. Reducing volatility, tortoise in the hare, protecting capital. These are all kind of terms that you've heard me say on this channel and in my different podcasts throughout time. So let me ask you this, protecting capital in the future, and then I want to ask you about your PIN, which is about energy. But protecting capital, what do you see in kind of 2020 and the next kind of market cycle? Do you see a big shift in ways that portfolio managers will manage to protect capital and to kind of reduce the downside exposure? Or do you still kind of see, I mean, we've had a lot of market volatility lately. Do you still see kind of strategy not changing long term?
Well, I'm going to answer your question in a bit of a different way, because I can't speak for what other managers are going to do. I'm going to suggest what I believe investors should do. And when you peel the onion way back, debt and demographics are unfavorable for developed markets over the next several years. The decade of the 20s is going to be very different from the decade of the 00 and the 10s. And the reason for that, unfavorable demographics, the dependency ratio is going up big time.
Yeah, so you mean the seniors?
Too many old folks relative to young folks.
Yep.
Debt, we all know that debt levels are at record highs. Yep. And I would argue that partially because of debt and demographics, combined with technology, that it's going to be tough for monetary authorities, fiscal authorities, to create inflation and inflate your way out of debt. And so consequently, I believe that all of those variables put together imply that growth is going to continue to get narrower and narrower, and the rate of growth lower and lower, which ultimately translates into lower profit growth, lower cash flow growth. And so consequently, as I write about in my monthly commentaries, which a viewer can find on my website, www.forgefirst.com, I've been saying for a fat year now that interest rates are going to stay lower for longer because of the lack of inflation and the subdued growth from debt and demographics. And consequently, when it comes to stocks, stocks are going to be driven by falling cap rates. So in other words, a cap rate is the inverse of a price to cash flow multiple. And so as interest rates go lower and lower, that means investors are borrowing more money or even just taking their existing nest egg and buying other assets because they don't want to sit in cash.
They can't.
And that's why the cap rate on real estate is going down. And I would say the cap rate on stocks has been going down. So for example, you look at the S&P 500. During the year 2019, it was up 30%. According to Goldman Sachs, 97% of the increase in the stock market last year was attributable to the price earnings multiple in the stock market going up. The price of a stock is a function of, the earnings and the valuation or the multiple that an investor is willing to pay for that earnings. 97% of the increase in the stock market last year was the multiple expanding.
So very little earnings growth and just the multiples expanding.
Right.
Kind of what I mentioned earlier, hitting the multiples at 20, 25.
Right.
Some significant multiples there.
And I had, viewers could go back and see my commentaries from several months ago where I was expressing a high degree of skepticism that China would reaccelerate in 2020, that Europe was going to be able to reaccelerate in 2020, their economic growth I'm talking about, and that the trajectory of US growth was going to remain better than these other large territories, but it was going to decline relative to the rates of growth we had seen in 19 and 18 respectively.
What do you say, Andrew, to someone who says, yeah, but there's nowhere else to go for investors. They can't go to cash. They can't go to fixed income. The 10-year rates are at all-time lows. Negative interest rates for like $20 trillion globally. Like, what do you say to the investor who says, I want equities are going to continue to trade at a high multiple because there's nowhere else to go?
Right. And my first response to that, Rob, and this sounds like a setup, but it was not a setup. Bottom line is markets have become increasingly difficult to navigate. Why? Because it's not 2009 when you could have bought an S&P 500 ETF, the spiders as we call them, and gone to the beach. Well, now we're 12, 13 years later. All markets are much more richly priced, whether it's bond markets, real estate, or stock markets, and consequently, depending upon the holistic needs of an investor, their cash flow needs, let alone their return needs based upon their lot in life and age in life, it's going to be a lot tougher for you to generate 7-8%, let alone not lose money over the next few years. So point number one, again, this is where it's not a setup comes in, I think you need financial advice right now, depending upon your situation. You can't just buy an ETF anymore. You could have done that 12 years ago, but now you need advice. And you and I have known each other for a good number of years. It's not like we hang out every week together, because you're in Winnipeg, I'm in Toronto, but we've had enough conversations over the last bunch of years that I'm well aware of the kind of due diligence that you and your team do on managers, for example, and how, from just philosophically speaking, understand how you take into consideration sort of the holistic needs of the 35-year-old couple versus the 75-year-old couple. The situations are very different. And the markets are going to be a lot tougher given that bond yields are so low, given that stocks are so elevated. And yeah, I understand the inclination is just to get longer the market, but I'm telling you the market's going to get a lot tougher, because I had thought that the global economy was going to see a decline in its forward rate of economic growth because of reasons I said a couple of minutes ago. But then now the coronavirus hits, and there's little question that it's going to further slow growth. It'll push Italy into a recession. It's probably going to push Germany into a recession. And if the U.S. consumers' confidence get hurt, it'll push the U.S. into a recession. If the U.S. consumer confidence remains high, then the U.S. may avoid a recession. But bottom line is, the world's a tough place now. It's not going to be as easy to make money over the next 2-3 years as it has been for the previous few years.
Gone are the days where you could just plop everything into a 60-40 portfolio,
Right.
60 stocks, 40 bonds, hope for the best, and go to the beach, as you say. You just can't do it. You're getting negative yield on your fixed income. You're getting potentially some troublesome times in your equities, ever more important where you take a look at real cash flow alternatives.
And taxes are higher too. Therefore, you got to make more to stay whole.
Yeah, so I would completely echo everything you've said. Obviously, one of the reasons you're here today, we definitely think alike. I do want to ask you about your pin. You're wearing a pin today that says, I love Canadian energy.
Absolutely.
So do I. I love Canadian energy. Tell me what you see in the future of the Canadian energy space. That's tough. You don't have a crystal ball, but
no. But
you're on a show, so that's what we do.
A couple of thoughts. First off, my hedge fund's at Forge First. Website's forgefirst.com. We're long Canadian oil stocks and we're short U.S. oil stocks. We've had that position on for about 9 months. Hasn't worked all the time, but directionally it is working now, and we believe it will continue to work. And the reason for that is pretty simple. The Canadian energy patch went through a real challenging time 4 to 5 years ago, whereas the U.S. energy patch was continuing to be propped up back then by private equity that was willing to pay $50,000 an acre to buy shale plays in the United States. Wall Street was continuing to allocate capital to the U.S. shale plays in the United States because the management of a lot of those shale oil companies in the United States would pitch half-cycle economics to the investors, which made the investors say, wow, look at the returns you're getting. Whereas up here in Canada, much more prudent management would always talk full-cycle economics, the difference being that full-cycle economics includes the cost of land, the cost of corporate G&A, and the cost of maintenance capital spending so that you can maintain your production and your cash flows. Bottom line is, Canada went through a challenging time 4 or 5 years ago. The U.S. hit the wall 12 months ago, and the U.S. energy patch is now increasingly having a difficult time, and we believe is going to have an incredibly rough 2020. So first off, that's the positioning of our funds. With respect to the energy patch itself, I prefer oil to natural gas. I think North America is structurally oversupplied in natural gas, and that includes after you discount into the demand of gas for natural gas in the Western Canadian Sedimentary Basin of the new petrochemical plants that companies like Pembina and Keyera are building in and around Edmonton, Alberta. That'll come on stream in a couple of years. Point number 3, from an ESG perspective, the Canadian oil patch generally is far better than what the media and the environmental bears like to suggest that they are.
Yeah, I agree with that comment.
And so, point number 4 is that, 4 years ago, retail investors went into the marijuana space. And so they didn't buy any resource stocks anymore. And in fact, they pulled their money from resource mutual funds. So now we sit here today that you have all these environmental bears on Canadian energy. You don't have any mutual funds that have the ability to write a check to finance a company. And so the stocks are dirt cheap. And as a result of having the problems that they had 4 to 5 years ago, the management teams at a lot of these Canadian companies have retooled their operations so that at $52 oil, West Texas, we're not there today, I totally get that, but I'm just picking a number out of the air. At $52 West Texas oil, you know what? They have pretty decent business models, let alone at higher prices. Meanwhile, the US shale guys, they're dying on a vine at $50 or $52 oil. So, over time, as the situation for egress improves, I should say, I think that you'll gradually see modest accretion in the valuation, the price to cash flow multiple that investors are willing to pay for Canadian energy. So, we like Canadian oil, we don't like US oil.
Fantastic comment. Guys, Andrew, I want to thank you for your time here today. We've covered a lot of topics here. If this is something you'd like to chat further with me, please go to www.speaktorob.com. We'd love to book a no obligation consultation. Love to chat with you about how you can protect your capital in times like this, how you can improve your cash flow, how you can take a look at holistic planning that you talked about for your retirement. Things have changed. We're not in the 2010s, we're not in the 2000s anymore. Returns have changed, asset allocation needs to change, and you can't just have a cookie cutter portfolio from a large firm that says, plop, here you go, this is what you own. It just doesn't work. Right. And we both agree on that. Andrew McCreath, and your website again is www.forgefirst.com.
Yeah.
Thanks so much for coming in today, guys. Thanks for tuning in. See you real soon.